Welcome back to another episode of Real Estate. It's been a particularly eventful year for the property market this year, and joining me in our studio to discuss the important milestones and the events that happened this year are three guests. I have Alan Chong, Executive Director, Research and Consultancy at Seville Singapore, Clive Chung, Associate Director, Red Brick Mortgage Advisory, and Bernard Tong, CEO of Ep20 Singapore. Now, the significant increase in market interest rates repeatedly made headline news this year. Concerns about the sustainability of our mortgage debt burdens and spurred government to introduce the 12 property cooling measures. Clive, could you summarize for us what the tighter loan limits and stricter stress tests mean for home buyers?
Yeah, sure. So I think the first one was the tightening of the loan to valuation for HDB loans. That fell from 85% to 80%, right? Other cooling measures are like your increase in the stress test for your total debt servicing ratio requirements. And the last one is actually private property owners. If they sell the private properties looking to downgrade into HDBs, for example, they have to now wait 15 months. Now, in my opinion, because for HDB buyers, if they want to purchase HDB now, you have to fork out a little bit more cash. This will tend to put them in a mind where you are more prudent, right? When it comes to property purchase, maybe instead of purchasing something that's $700,000, you look at $650,000, for example, because you have to fork out a little bit more cash. For the increasing of the stress test, I wouldn't really consider that as a cooling measure, because as interest rates increase, it's only natural that the banks increase their stress test, right? And this essentially reduces a person's loan eligibility in total by about 11% in total, right? From the beginning, when your stress test was at 3.5%. So definitely, people will also start to be a little bit more prudent when it comes to spending money on properties. I don't think they will stop spending, but they would probably spend a little bit lesser. For private property owners who are looking to downgrade initially, I think that has an impact on the HDB market, right? Because now with the restriction, you're not able to buy 5-room flats. You probably have to look at something smaller. So private property owners may just jolly well turn back into smaller private property units instead of going back and recycling capital in the HDB market. So on that aspect, I reckon that HDB prices will taper just a little bit. Yeah.
Now, Alan, we've had about 2 months now to digest the impact of these new round of property cooling measures. Did we see like a knee-jerk reaction like what we saw in 2018, 2021?
They have not really been having that negative impact. First of all, the market is used to repeated interventions in the market, and so they are sort of adapted to what's expected to happen. So it wasn't a surprise. Secondly, this year, because we only had approximately 5,000 new units launched from less than 17 projects, it's very difficult then to measure the impact of the cooling measure because you cannot plumb the depth of where the measures would affect the people at the fringe. It could be that if you had more than 10,000 units launched, then perhaps the cooling measures may have affected a certain percentage of that. But at 5,000, we can't tell.
Now, over at Ep20 and our sister company at Singapore, we really like to keep our ears to the ground. We like to hear sentiment from all stakeholders in the property market. Bernard, from the engagements that you've had, what is your impression of the property market, the residential property market this year, amid all this volatility and change?
If you look at the Singapore real estate market in isolation, and if you compare that to the preceding years, so if you're talking about 2020 and 2021, obviously 2020 the prices have remained resilient, right? But volume has come off for certain asset classes. So generally you may think that because of the impact of the higher interest rates and the impact of the new cooling measures that were introduced, the market has sort of cooled off. But if you look at the Singapore market relative to all the other property markets, whether it's regionally or globally as an asset class, has been very resilient. Now, if you break down into the specific types of asset classes when it comes to Singapore residential market. So for example, if you look at the HDB market, all we heard about this year is the $1 million HDBs, right? So we know that HDB prices have continued to increase this year. Volume has remained relatively steady. But despite that, HDB is probably the cheapest asset class when you compare it on a PSF basis, right? Compared to, say, a landed property or even a private residential market. Even the landed property, right? So I think landed property 2021 was probably the best year in record, but 2022 has sort of come off a bit. But despite that, prices continue to rise. So I think the market that has been affected is probably the private resale market, right? So I think 2021 we have 16,000 resale condos that were being sold, but 2022 I think we are on track to probably only hit 11 or 12,000. That's a decline of 30%, right? So I think the rising interest rates and the rising inflation have sort of impact on this market. Obviously, we talk about the new launch market, right? I think the recent launches in the market have done very well, right? So if you look at Amor Residence, Lentor Modern, even Coppen Grand as an EC, sold out in space of 2 months, 3 months. So I think generally the lack of supply in the new launch market has helped the launches this year. But I think 2023, I'm a slightly more bearish, looking at the conditions that are in the market, right? And the number of supply that is in the pipeline. I think developers would need to be a bit more creative in order to stand out in this market.
Yeah, that's right. And then, following up on what you said, it wasn't even the headline projects that we saw doing well, Amor Residence and Lentor Modern. We also saw some of the smaller projects like Pollen Collection also sold very well. And some developers took that opportunity to start releasing units for sale. We saw that at Cape Royal also when Hobie released some new units for sale, and that was also very well taken up. Now, another thing that happened this year was the rental market. We saw very strong activity in the rental market. Can you briefly describe to us what happened here this year?
This year's rental colours are quite different from what transpired in 2020 and 2021. So the history was that in 2020, there was an outflow of foreign employment pass holders and rents fell, right? But it did not fall as much as we expected because there were Singaporeans who came back from overseas or even PRs who took back possession of their leased out units and they stayed in Singapore to squat it out or ride through the pandemic. So they reduced the inventory that was freed up into the market. But the market still had some slack. So in 2021, things started to stabilize. We saw less outflow, but the market was still relatively soft. But coming towards the end of 2021, we saw the market tightening up because there were borders were opening up, so it absorbed the slack. And once the slack go below 6%, which we think is the natural vacancy rate, rents start to skyrocket, right? And we are around 5.75% vacancy rate for non-landed properties. So in 2021, we saw that happen in the second quarter. So the natural vacancy rate was pierced from the top down, and there was no more slack in the market in the rental stock, and rents just went ballistic. So it started last year with the CCR when the C-suite guys started moving in, absorbed the stock. The big moves happened in the CCR last year. RCR and OCR didn't move much last year. Now it is RCR and OCR, in particularly OCR. 1 year ago in Jurong East, for example, a 3-bedroom would be about 3,700 a month. Today it's about 6,000. So the sort of percentage increase basically is not really captured in indices.
Now, Clive, talking about interest rates, there's a lot of uncertainty now going back into 2023, how much higher it might go. What are your thoughts on how much further it can go up? And what does this mean? What do you think it means for the property market next year?
Current interest rates in the market at this point of time for a fixed interest rate, you're looking between 4.25 to 4.3%. We do expect coming December, the Feds would raise maybe by another 50 basis points, and moving into next year, February of 2023, probably another 25 basis points. So in the shorter term, we do anticipate interest rates to continue going up. If that's going to be the case, the local banks are definitely going to react. So you're going to see interest rates now at 4.3, maybe they'll trend closer to the 5% mark. Sentiments on the ground when I speak to people is that some of them have started seriously considering this because the cost or the burden of owning a home is much more expensive as compared to the start of the year. Some people who are looking to purchase properties have held back a little bit, and some of them even started moving into the rental market as well, right? Which then drive rental prices up again. But this is not going to come down unless we see inflation come down, unless we see wage growth data in the US come down. So in the shorter term, I think this would definitely have an impact on prices because if buyers start sitting out of the market, sellers have a limited pool of buyers to work with, they may just be forced to lower prices a bit.
And Alan, what do you think? Will we see a taming of prices and demand for the private and public markets?
For the private first, next year will be interesting. There is 11,000 or 12,000 units that will be launched from more than 40 projects. This year, as I mentioned earlier, it's only 5,000. So next year will be a lot of slack, and buyers are now also wary of interest rates. So we have these two forces clashing, and they are on opposing ends of the price spectrum. They will cause price to move up or down. However, I think moving into 2023, all the launches are from projects which have high land costs. So developers will not, at the first instance, sell at a loss. So if they sell at a cost plus, that cost plus is still going to be higher than 2022 prices. And we will see price increase. We will see sales volume increase because there's now more supply. Demand chases supply. Developers will not lower prices, and they may then not sell 70, 90% at the first instance, at the first weekend of launch. They may sell half of that, maybe 40%, 50%, and defer the unsold stock for a relaunch in 2024.
So Clive, touching on the launches that we saw in 2020 and 2021, for example, we saw units being moved at the M over at District 7 and at the Atelier in District 9 and Klim at Kenil at District 9 as well. Both of all these projects started moving units. But those buyers enjoyed a relatively low interest rate environment. For those who bought units in 2020-21, now going into 2023, what's it going to be like for them?
They are going to be hit quite hard. Because if you bought your property in 2020 or 2021, you would have been enjoying fixed interest rates at the 1-ish% levels, 1.15, 1.2%. If inflation still stays high, the US Fed doesn't start pivoting and lowering interest rates, they would probably expect interest rates to definitely be above the 4.5% level. But otherwise, I think it's always prudent to start preparing for that. Start cutting back on some expenses. So unfortunately, the banks are not going to say that, okay, because you have signed up with very good interest rates, we're going to give you a continued period of lower interest rates. No, the banks would charge you whatever is being charged in the market.
This year, we saw some remarkably high take-up rates for some of the new launches. As Bernard mentioned, Amor Residence, Lentor Modern also, the integrated development at the Lentor area. Developers have been busy working to top up their land banks amid dwelling unsold inventories. What does the pipeline of new private residential supply look like in 2023, and do you think the overall absorption rate could take a hit, especially if there was a recession fear?
In 2023, we have more than 40 plus projects. For each project that's launched, I don't believe that you will get a 80-90% sellout rate in the first weekend of launch. It may fall back to what is considered a normal take-up rate in the first weekend of about 45 to 55%. But for the first launch, they will still sell at cost plus or benchmark against the previous market launch. Now, bear in mind also this year, they had set the benchmark in the OCR for more than $2,000 per square feet. So next year, when we move into 2023, we see in the Lentor area, we also see new to market launches in the Jurong Lake area. They will be launching at a benchmark price of chances of more than 2,000 per square feet. That will be a record for Jurong East. So that should lift the price index, hedonic price index for that part of or the subzone. Take-up numbers will increase, but as long as you don't have a take-up rate of say 3%, 5% on the first weekend of launch, developers are unlikely to blink. So 2023 may not still be the year of reckoning. It will be 2024, and much depends on whether the GLS pipeline is turned on to increase the supply from the GLS program. Then if you have the increase in supply and if there are collective sales piled in or added on, then come 2024, the unsold stock in 2023 will be moved to 2024, and then we have a bulging up. But prices in the new sale market may still be holding up or rising a little. New sales will collapse, but then the resale market takes over. Because if it's a shock to the system, the resale market will feel the impact.
If I may add a little bit on the absorption rate, for example, for new property launches as well, when someone purchases a new development that is just being launched, they don't bear the full brunt of high interest rates as well, because loans are progressively disbursed. This is a mitigating factor as well, because if I'm going to buy a property and I know that the property is going to be completed in 5 years' time, for example, my runway in the next 2-3 years, even if interest rates go sky high, for example, my cash flow is still manageable because the amount that has been dispersed is relatively lower. And developers may also just come up with deferred payment schemes, right? Where you pay that, the initial down payment and you wait until the property has obtained its TOP before getting a loan, basically. So this may also help people who are looking to get into the private property market but are concerned about rising interest rates.
And it's good that we're talking about new launches and the pipeline of supply that we're seeing. Ep20 publishes a map each year that highlights the launches that occurred this year and upcoming launches. At the end of this year, we're going to see our own map with launches that happened in 2022 and the number of launches that will occur in 2023. Bernard, can you give our readers a glimpse of what we can expect to see in this special issue?
This is an annual effort by Ep20 where we put together a map, both online as well as on print, where you can look at all the upcoming supplies and upcoming launches for 2023, as well as the projects that have been launched. I think next year it's going to be pretty exciting when it comes to the number of new launches. So we are talking about something like 40 to 45, totaling about 11 to 12,000 units, which is double what it was this year. Please remember to check it out. But beyond that, we also do a quick recap of the key events and key milestones that happened in the property industry throughout the year.
Thanks, Bernard. And I think some of the projects that I personally will be looking out for are Newport Residences, the redevelopment of former Fuji Xerox Towers, also the Marina View plot by IOI Properties, and also further afield, Blossoms by the Park and Botany and Dairy Farm. Both projects which I think buyers are keen to see launch and see what the developers have in store for them there. That's all the time we have for this episode. I want to thank Alan and Clive for coming down here and sharing their insights on the property market, and for Bernard for sharing what Ep20 has in store for our readers at the end of this year. As always, thank you for watching Real Estate. Real opinions, real statements.